Okay, welcome back to Accounting 101 YouTube video where we are going to go over the solutions for the Chapter 8 assignments as per the syllabus. And important announcement, saying that we are working a short week this week on campus and that my day classes are about a half a week behind you folks. You're getting this tape and the Chapter 9 stuff will come out next week. I don't know if I'll do it Saturday or Sunday. Sunday's Easter, but I'll do the tape and I'll send it out over the weekend. The latest maybe Easter Monday. So you get a little bit of a breather, sort of a second mini spring break. Okay, what do we have here? Chapter 8, questions 1, 4, 5, 7, 8, and 9 review questions. Am I in the right chapter? Yep. So, review question number 1. The accounts receivable represents a right to receive cash at some future point in time from customers for goods or services, goods sold or services provided. They're usually collected within a short period of time, 60 days, hopefully 45 or 60 days. Usually after 90 days, the uncollectability goes up quite significantly. Notes receivable are usually longer term than accounts receivable. Plus, it is a written document that supports it. The accounts receivable is just a agreement, sort of a courtesy given to customers to extend them credit. A notes receivable is actually evidenced by a written document with the debtor signing their name as acknowledgement of the debt. It's dated. It has a maturity date by which the amount must be paid. They usually bear interest. So that's some of the differences and similarities between notes payable and accounts payable. Number 4. This won't advance. Come on. What is, again, I don't have the questions in front of me, so bear with me. Just have the answers prepared. I would imagine it has something about the control account, accounts receivable, and the individual accounts in the subsidiary accounts receivable ledger. So a business must maintain a separate accounts receivable account for each customer it deals with on credit in order to account for payments received from the customer and the amounts still owed. All the sales and collections from the customers are tracked in that account along with the balance. Years ago, I was doing an audit on a small fuel oil dealer, and it was so small. I was doing, they had a business on one side of the road and the other side of the road. It was very rural country, about 20, 30 miles from here. And I had to do the audit in their house, and the wife was, I guess, the bookkeeper, what have you. So I'm doing various things, and then I got to the point where I'm going to do a sampling of the accounts. And I asked her, how do you keep track of what you sell to your customers and what they pay you and what is owed, or if anybody has a credit balance? And she said, what do you mean? I said, well, when your deliveries are made, you write up an invoice, how much gallons and how much per gallon, and how much. So sometimes people will pay you ahead of time. Some people will pay you at delivery the full amount. Some will give you a partial payment. How do you keep track of that? She said, we don't keep track of that. The truck drivers keep track of that. And I said, what happens if a truck driver hits the lottery and quits, or God forbid, gets in or out of the truck, slips and hits their head and gets amnesia, whether it's temporary or permanent? She said, she asked me, there's a way you can keep track of that? I said, yeah. I open up my briefcase and I get out a 3-column paper, and I said, go to Walmart or Office Depot or wherever online and get one of these for yourself and put the person's name, last name first. You can put them in order that way. You can give them customer numbers and keep them in order that way. And I said, this first column is what you sold the customer. The second column is any payments they make, and the difference between those are the balance owed one way or the other. And she said, that's pretty neat. Is that something new? I said, well, it's back in the 1600s, some Italian monk developed it. And so I said, I guess whether it's new or not is relative, depending how old you are and your view of the universe. So, the individual accounts. Again, you got credit cards. There's a big long number on that. Every credit card has a unique number on it. And that's how they keep track of what is charged on that account and your monthly payments and your balance, whether you have a credit balance or a debit balance. Number 5. Well, that's an easy one. The control account and the total of all the individual customer accounts must equal at any given point in time. In fact, the control account, accounts receivable that we've been playing with all semester, or working with, I should say, that number comes from the collection of all the individual customers' accounts receivable. So whatever they add up to in total, that is what's reported in the master or control account. Let's see, 7. When a business factors its receivable, it is selling the receivables to another party, usually a finance company or a bank. Okay, the business receives the cash less any applicable fee from the factor for the receivables. Usually they'll sell at a discount. You'll sell $10,000 worth of receivables for, $9,700, $9,500, because whoever you're selling to is going to have to wait to collect them. Plus, they're bearing the risk of uncollectible accounts unless they're sold with recourse. So now the person or the party buying them now collects the receivable from the party that owed the money to the business. And the business no longer has to deal with the bookkeeping, record keeping, or collection efforts. All right. 8. In a pledging scenario, the business uses its receivables as a collateral for a loan, security on a loan. Usually when you have a collateralized loan, you get a little bit advantageous terms, or sometimes the bank, if you don't have a good credit rating, the bank will require collateral. Okay, but the difference between factoring is an outright change of ownership. You're selling your asset, accounts receivable, to another party. Once the sale is complete, you no longer own it. When you pledge it, you give up the right temporarily to collect on it, or you pledge the receivables that if you don't pay the loan, if you default on the loan, then the creditor can come after the receivables for payment. They can go to your customer and say, hey, they owe us money. We have a piece of paper here that we have loaned them money. And it says that if they don't pay us back, we can come to you people that owe the business money, and you pay us to extinguish the debt they owe to us. So that is a pledging or collateral situation. Okay, the business is still responsible for collecting and still runs the risk of uncollectability. And if the loan's not paid, the bank collects on the receivables because they're pledged. It's a written document, and it has everybody's rights and responsibilities therein. It's a contract. 9. Bad debt expense is an expense account associated with the cost of uncollectible receivables. All right, let's get into the short exercises. Short exercise 5, 6, and 7. Okay, what do we have to do here? We have to record some journal entries, okay? So we had situation A. Looks like we had sales of $273,400, so we will debit the asset accounts receivable. And let me jot it down here. And sales revenue will get the credit. or just sales. And I guess this is for a whole year, $273,400. This pen looks like it's about to run out of ink. So there's the entry for situation one. Let me see if I can dig in here and get a better ink pen. Hopefully this one works nicely. And we have payment on those receivables. So we get some cash. So cash is increasing. It will get a debit, $223,000. And the accounts receivable will be reduced by the amount that the certain customers paid us. Very simple rudimentary entries. Now the allowance for bad debt, it says, is $5,900. Let's see. Okay, so we will. That's I think we're writing off there. Yeah, that's a write-off. Okay, so the allowance already has had a balance of $2,000 in it. So we're writing off $5,900. So when we have a write-off, don't forget the allowance, the bad debt expense, and the allowance have already been taken previously. We've had an allowance estimate and a bad debt, and that carries on from one year to the next. The allowance account, the allowance for bad debt account, modified. So when we write off an account, we're going to reduce the allowance account and have a corresponding reduction to the accounts receivable. Because if you have, I hope I did this back in the lecture part for chapter 8. Let me set this up here just as a review. I'm going to abbreviate allowance number 4, BD, for allowance for bad debt. So let's put some numbers in here. Let's put accounts receivable at $100,000. And we think 2.5% are going to go bad. So we would do a entry for $2,500. That entry would have been a debit to bad debt expense and a credit to the allowance account. So our net receivables are $97,500. Now, if we write off an account or several accounts to the tune of $5,000, we would have $95,000 balance in accounts receivable. So if we wrote off $5,000 of accounts receivable, this amount here was based on the $100,000. So we have to reduce it. Because it's no longer a balance of $100,000 in accounts receivable. It's been reduced. So whenever we write off, we've already recognized the bad debt expense, but now we have to reduce the allowance because of the accounts receivable being written off. So that entry will look like this. Allowance for bad debt, normal credit balance is going to get debited to reduce it. And the offsetting credit is going to be the accounts receivable that are written off once we identify them. That's going to get the credit. And then finally, we have to do the bad debt expense for the year. And that is going to just be a debit to the bad debt expense account. And a credit to the allowance account. Allowance for bad debts, $5,200. Okay, now let me set up the T accounts. Just bear with me. By the time I stop the tape and restart it, it's just as quick letting it run and listen to me babble on. Allowance for bad debts. Okay, so we had a beginning balance on December 31 of 2023 of $10,800 in the accounts receivable, and the allowance had a $2,000 credit balance on December 31, 2023. Okay, so there's our starting point that was given in the problem or in the short exercise. Now we have to post the amounts of those transactions. So when we had from part A, I'll put the letter A here and circle it. We had credit sales of $273,400. That would increase the accounts receivable. The payments that came in from entry B, the payments, were $223,000. Then we had the write-off of $5,900 from Part C, or Information C. And with that $5,900, we would also have to post that to the allowance account. So now the balance of the allowance account is $3,900. So item D would be the adjustment needed to get the balance where we want it to be, or the expense, $5,200 credit from Part D. And all we have to do now is get our end of year balances for the receivable and for the allowance account. So what do we have here? 10,000, 55,300 at 12/31/2024. And in the allowance account, we have a credit balance of $1,300 at December 31, 2024. And that's what it would look like after we post those items A, B, C, and D to the receivables and to the allowance account. We're not going to worry about the cash and the bad debt expense or the sales right now. You would in real life. And I guess they want the bad debt expense account. Well, that's straightforward. Show you what that would look like. That expense. So put my foot in my mouth one more time. We would have the adjusting entry for $5,200. balance at 12/31/2024. Would have a balance of $5,200. That's a bad debt expense for the year. And of course, being an expense account, it would get closed out during the closing process. And I guess lastly, they want us to show what it would look like on the balance sheet. So you'd have the name of the company, signature lamp, company balance sheet. And again, it's just a portion of the balance sheet. You have assets. And then you'd have your current assets. And you'd have cash, and we don't know what it is. And then followed by accounts receivable. And you would show the total amount. Less the allowance. For bad debts of $1,300. Again, that's the balance of the account, not the expense for the year. And the net amount of $54,000 would come over. I'll just make a cash $100,000. That's not giving the problem. I'm just making it up so you have a number in there. And that's what it would look like. Again, you'd have the other assets, and then you'd have the liabilities, stockholders' equity. They don't give us any of that information, so we can't complete the balance sheet. But we did have, in fact, the only information they gave us was the accounts receivable and the allowance. And we're showing the gross amount, the allowance, and the net amount over here. Cash, I just made it up so we'd have a number to correspond with the label cash. Okay. Short exercise 6. Again, they give us a scenario where we're calculating the bad debt expense as a percentage of credit sales. So what do I have here? December 31, 2024. And we have bad debt expense getting the debit. With the credit going to the allowance account. And they told us that it was 3% of credit sales. So credit sales are $311,000 times 3% is $9,330. So that's the amount of the expense. And the amount we're going to credit the allowance account for. I guess this would be a good time to reiterate the fact that when we use the income statement approach, the calculation is going to give us the bad debt expense for the year. If we're using one of the two methods under what is called the balance sheet approach, a percentage of sales, or an aging of the receipt. A percentage of income statement approach is a percentage of the credit sales. The balance sheet approaches are a percentage of the accounts receivables or an aging of the receivables. In the balance sheet approach, using either of those two methods, what we get, the result of our computation, is the desired balance in the allowance account. So we have to back into the expense, because we have to consider the beginning balance of the allowance account. It's either going to be increased or decreased. All right. So that was to record the bad debt expense for the period. And then they want to see how that would look on the balance sheet. So we have wine tour. Again, if anybody likes wines and you want to go on a tour in New York State, if you go in the fall, you see the nice leaves, but also fall is the time when they disgorge the champagne. It's the only time of year they do that. Disgorging champagne is when they have I don't even know if the smaller wineries do it by hand. They have them in racks. They turn them, and then the disgorging is they have them upside down so all the sediment will fall down, and then they freeze the neck of the bottle, take the cap off. The pressure will push that little frozen slug out with all the sediment in it and particles, and then they put the cork in and sell them to you and me. So again, we'd have assets here, and we're only going to do part of the balance sheet. And then you would have your current assets, and they're not even showing it here. They're just showing the accounts receivable part, but just for sake of comparison and consistency, I'll put cash, and then we'll have accounts receivable. And then we will offset it by the allowance for bad debts. And I'll once again make a number up for cash. Let's see what the receivable is, 300,000. So let's say 90,000 for cash. Again, just making that number up so I can demonstrate it here. Then the receivables are 44,000. And the allowance is 9330, which is subtracted from that. That will give you 34,670 net realizable value of the receivables after the allowance is taken out. And that's what you're looking at, something that looks sort of like that. Name of the company, name of the balance sheet, the date, assets, current assets, cash. It over in the column. In the middle column, you have the gross receivables of 44,000, less the allowance of 9,330 for the net amount of 34,670, which would pop over right under the amount for cash. Okay. Again, the format helps people figure out how to read, how to focus on the information that's given. Let's see, number 9. Oh, I'm sorry, 5 short exercises, 5, 6, and 7. Got to do, didn't finish up there. Let me get that paper off the floor. And they wanted us to do what here? I'm sorry, I didn't do, which one am I doing here? No, that was 6. Okay, get rid of 6 and start 7. All right. Bear with me. I had a tough day this morning. My internet connection here at the house was acting up, and I got way behind. Okay, so short exercise 8-7. They give us accounts receivable balance here and some information. And what do we got? That's all we got. Okay, we got our 12/31/2023 balance, and I'm assuming they gave it to us as $20,000. So I'll just set that up like that. And then let's say we had net credit sales of, I guess probably, okay, they didn't show that. Net credit sales of $454,000. Okay. Net credit sales. And then we had $325,000 in collections. I'm doing this right into the account as opposed to writing entries. And then we had $5,600 in write-offs during the year. So that gives us a December 31, 2024 balance of $143,400. So there's all the information that I put down while I was mumbling. Beginning balance of 20,000 on the debit side. It is increased with a debit of 454,000 for the net credit sales made during the year. Over on the credit side, we had collections on the receivables on the credit sales of $325,000, and we had write-offs of receivables that were identified as bad of $5,600. Again, leaving us a balance of $143,400. Again, those write-offs are actual ones that have been identified as bad, and we've written them off. We've previously allowed for the expense for those. We didn't know who they were going to be. They're estimates. So now we have to do a computation, or we have to do an entry for the allowance for bad debts, which they say is percentage of the receivables. So the receivables are $143,400. They say 5% is going to be bad. So that would be $7,170. Okay. Accounts receivables, and that's the percentage. So there's a calculation up here. A receivables balance, $143,400. They say 5% are going to be uncollectible. So $7,170 is going to be our target figure. So did they give us the T account here for the allowance? No. So it's a little bit different here. Requirement 1, I would imagine the allowance account allowance for bad debts. It had a balance of $2,700 in it, right? Get my handy dandy little handheld calculator out here. Okay. So in this case, we're using the percentage balance sheet approach. So our calculation gives us a target we want in the allowance account. Okay, so here's our beginning balance in our allowance account, $2,700. Here's our targeted balance that I brought down from the computation, $7,170. So how much do I have to increase the allowance account by to get there? So I have to increase it by the difference between those two numbers, or $4,470. I'm going to put that in red so it'll stand out a little bit better. $4,470. So here's the beginning balance. Here's the desired balance. So I have to increase it by the $4,470. Doing it backwards, put it in the account first. Now I have to write the journal entry. So it would be bad debt expense, $4,470, and the allowance for bad debt. Okay, in requirement 2, they change it up on us a little bit. They say the balance in the allowance account was a debit balance of $2,400. And that's possible if you wrote off quite a bit of receivables during the year. You can end up with a credit balance. It's an abnormal balance, but it's possible. Bad debts. And what do we have here? A $2,400 debit balance. Okay. Just setting up requirement number 2. There's the balance, $2,400 debit balance, though. Now, nothing has changed. Our calculation based on the receivables balance, the balance of accounts receivable, and the 5% still hold true. So we still want a target of a $7,170 credit balance in the allowance account. So let me put this in red. So the red question mark is, well, how much do we have to credit the allowance account to go from a $2,400 credit balance to a $7,170? I'm sorry, a $2,400 debit balance to a $7,170 credit balance. And in that case, you add them, and the amount would be, scratch out that red question mark, and I'll put in $9,570. I'll put the entry right next to it here. Bad debt expense, allowance for bad debts, $9,570. So again, that's the balance we want. We're starting with a debit balance. We want a credit balance, so we have to increase the allowance account by $9,570. Put that in there, and you get the desired balance. Okay. Okay, exercise 15. Okay, exercise 15. The internal control weakness is that the credit department receives incoming cash from the customers. The credit department should only handle determining if a customer should get credit and how much their credit limit should be. They shouldn't touch cash. They shouldn't touch the accounting records. Separation of duties. With access to cash, an employee in the credit department can pocket the cash received from a customer and destroy the remittance slip. The credit department can then write off the customer's account as uncollectible, and the company will stop pursuing collection from the customer. To strengthen controls, the company can have the cash go to a lockbox at the bank, direct deposit, or have the company mailroom, not the credit department, open the mail, receive the payment. An employee that is outside of the credit department should handle the receipt of the cash. Okay, so that's what the internal control weakness there was. 16. Okay, we have a bunch of transactions here. We got to do the journal entries, and then we have to do the individual accounts, subsidiary ledger. All right. Okay. It's going to take a little time for me to set this up. Maybe I'll walk through things as we do it. Now, let me see how many lines I'm going to need here, if I can get it all on one sheet of paper here. 1, 2, 3, 4, 5, 6 would be 12, 13, 14, 15, 16, 17. So I get 17 lines. 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 17. Okay, so down here I can start doing my T accounts. All right. I'll put the general ledger over on this side. I'll put the subsidiary accounts receivable ledger on the right side. I'll show you what I'm doing. So I left room up here for all my journal entries. That's why I counted. And over here, I'm going to have my general journal accounts. And then over here is going to be the subsidiary accounts receivable accounts. So I'll draw a line down here. Let me get my roller. Nice. I just did that so you know it's two different documents. So over in the general ledger, we are going to have a cash account. We're going to have accounts receivable account. And we're going to have a sales account, sales revenue. Okay, over in the subsidiary ledger, we're going to have, I don't know what that is. See if I can tell from up there. No name on it. Carter Company, okay. Carter Company, Driver and Iris. Up in the end, only three. Iris, Driver, Iris, Carter. Okay, they got them all. Okay, sales revenue. Okay. All right, let me show you what I got here. If you did it good, if not, you can get up to speed following my example. What I have down the bottom on the left-hand side is my general ledger with the cash account, accounts receivable control or master account, and a sales account. Over on the right side, backwards, so yeah, that would be right because that's my left hand. I'm looking at a reflection of what I have on the screen. So I have a subsidiary accounts receivable ledger. I have an account for Carter, one for Driver, one for Iris, our three customers. So now we're going to do the journal entries and post to the accounts. So on June 1st, what do we got here? I don't have a year, but we'll just call it June 1st. We sold to Carter on credit. So we'll do. I'm going to abbreviate to save some time here. A/R for accounts receivable, Carter Company. And credit sales revenue. I'll show you this as soon as I get the numbers in it. Was $1,575. Okay, so there's the entry. So I'm going to now post that entry. Carter, 1575. Oops. Did it on the wrong side. And 1575. So there's the debited Carter's account receivable in the subsidiary ledger and sales. I'm going to hold off on the receivables until I get all the individual ones down. Oh no, I'll do it. I'll do it now simultaneously. So accounts receivable, 1575 in the master or control account. So two counts. The subsidiary account for Carter, for Carter, and the master picks up the 1575 for that credit sale of June 1st. Hold on, I've got something going on in the phone. Not even going to shut it down. Sorry for the interruption. All right, so on June 6th, we had a cash sale. So cash will be debited, sales revenue credited, $550. So let's post those amounts now. The cash account gets a $550. I guess I should put the date on here. 6/6. These other ones would have been June 1st. Okay, and sales revenue, $550. 6. So I threw in the dates down here for the first one because I didn't do it. And then the second one, I just cash is debited, sales revenue is credited, or just sales, and then post those down below. June 12th comes around, and let's see what happens on June 12th. We get a payment from Carter Company. Okay, so cash is going to be increased by $1,575, and the accounts receivable due from Carter is now credited for $1,575. And now we will post that. So the cash account gets $1,575 for that collection. Carter gets credited $1,575 on 6/12. And the accounts receivable gets us credit the master account. So every time we have a transaction involving a specific customer's account receivable, we have to post it in two places: the control account and the individual account of the customer in the subsidiary ledger. Okay, on the 20th of June, we sell on credit to Iris Company. $765. Sales revenue gets the credit. The debit goes to the accounts receivable for Iris. Now we post that amount. Again, we're going to make a posting, one debit and one credit in the general ledger, and then the subsidiary accounts receivable subsidiary ledger, that individual customer's account. So again, sales $620, $765, and now Iris $765 in the subsidiary journal on $620, and in the control account for $765. So you can see the cash account and the sales account down the bottom got the cash account's not affected. I'm sorry. The individual customer account for Iris gets a debit for $765, a corresponding $765 to the sales account, and the master control account gets a $765 debit to agree with what's in the subsidiary. June 22nd, we have a sale to Driver Company, $230. Again, abbreviating AR, A/R for accounts receivable. Sales revenue for Driver Company. I didn't put company up above, so I just wrote it in now. You'll see it when I put it up. $230. Oops. So here it is here. Accounts receivable for Driver, $230. Sales revenue credit for the same amount, $230. Now I'm going to post that. So the accounts receivable master account gets a $230 debit on the 22nd. The sales account also gets a credit of $230, and a driver company individual customer account in the subsidiary ledger gets a debit. Okay, so there's driver company, $230, the master account, $230, the sales account, credit $230. Finally, we have a payment on the 28th coming in from Iris Company. So cash is going to be debited for $300. And accounts receivable for Iris Company is going to be credited for their sending in their payment, $300. So there's the entry right there. Cash, debit, accounts receivable, Iris credit, $300 each. So now let's post that. So cash goes up $300. Iris Company, individual subsidiary ledger gets a credit for that payment. And accounts receivable gets a credit to master account, $628. So there's the postings. Iris account gets a $300 credit, $628. Down here, the accounts receivable gets a credit, $628, and cash gets a debit for $300 payment on $628. Now, I guess they want us to determine the balance. Okay, so cash. Yeah, what do I have here? 300, 765. What did I put that 7 on? 620. 620. I made a mistake. That 620 amount, a 765, I put in, no, that's a sales account. I'm sorry. I'm looking at the cash account. That's all right. 765. I'll be all right. Okay, so the cash account, I got 3 entries. June 6, 550. That was a cash sale, and then received a payment in full from one of our customers, $1,575. I forget who it is. Carter Company. And then a partial payment from Iris Company of $300. So that totals up our total cash there. It would be $24.25. Our accounts receivable, we have the $1,575 debit on June 1st, June 20th, the $765 debit, and June 22nd, a $230 debit. And we have 2 credits, one on June 12th for $1,575 and one on June 28th for $300. So the balance there would be $695. Okay, so here's the balance of cash, $24.25. Here's the balance of our receivables, $695. Our sales revenue would be $3,000. I'm going to put it over here so you can see it because I ran out of room. $3,120 in our sales. Okay. Just made a little T account over here and brought the balance over. That's a credit balance. There's the debit side where the arrowhead is. $3,120. Now to go back and look at our individual accounts for our 3 customers. Carter Company is a 0 balance. They bought $1,575 and they paid $1,575. June 1st, they incurred the debt. June 12th, they made good on it with their payment of $1,575. Carter charged $230 worth of merchandise and they didn't make a payment, so they owe us $230. Right there. Just the original sale, no payment. Driver, they charged $765 worth of merchandise, and they paid $300, so they have a balance of $465 left that they still owe us. Right there, the original amount, partial payment, the balance they still owe. Now the trick is, hopefully this highlighter will show up good. We want to figure out to see if the balance in the receivables in the subsidiary ledger agrees with the control account balance. So we have driver receivable is $230, and Iris's accounts receivable, and this is from the subsidiary ledger. I'm getting these amounts. 5, 9, 6. So I went through the subsidiary account, highlighted it. There's a balance at the end of June for driver, $230. And Iris owes us $465. So over here, I wrote them down, $230, $465, add them together, $695. Let's see how that jives with what I have for the receivables balance. Yay, they agree. Here's the master control account, 5, and those two accounts. So that's pretty good. And I just dropped my one sheet, so I got to retrieve it. And let's see here. Is there anything else they asked? No. Okay, they could have showed in that little summary I did for driver and Iris. I showed the balance. I didn't show Carter. Carter has a zero balance. You want to put a summary subsidiary ledger. Carter 0, driver 230, Iris 465. Total is 695. That was 16. Now we have to do exercise 20. Okay. You write down the page here. 19, 20. Requirement 1. All right. 20. They give us some transactions. We have to record them here. Okay. So we had a transaction A up here. And it said we sold $185,000. We had $185,000 in sales. $21,000 were for cash. The balance would have to be for receivables. So let's record that sale. I'm going to do this a little bit, bottom to top here, so you could see exactly how I figure that out. Because again, I don't have the book here in front of me, so I don't know what they're giving you. I'm trying to back it in. So there's credit sales, or I'm sorry, there's total sales, $185,000. And they either told you both cash and credit sales, or told you one but not the other. So I'm going to put in cash of $21,000. And then the balance would have to be to the accounts receivable. Maybe they told you what the receivables were, and you'd have to back in to the receivable amount. Either way, I'm thinking they gave you either the receivables or the cash, maybe both, but they gave you, there's 3 pieces of information there. They're giving me 2. I can figure out the third one, or they're giving me all 3. I don't know. We had a collection of $135,000. So cash gets debited and accounts receivable gets a credit. for the payments that came in from customers. $135,000. And then we had to do a calculation. For the allowance. Again, I don't have to telling you what it is, or we have to calculate it out. We had a write-off of $2,300 in item C. Allowance for bad debt is reduced, and accounts receivable is reduced for the same amount. $2,300. Okay, now we draw a couple T accounts here. Accounts receivable and an allowance account, modifying it. And we had a balance January 1st, 2024, $28,000 in the accounts receivable. We are going to have the net credit sales of $164,000 during the year. Credit sales. And we had $135,000 in collections. And we had the write-off of $2,300. Or write-offs. And that will give us a balance at 12/31/2024 of $54,700. On the allowance for bad debt, we had a $3,000 credit balance at January 1, 2024. And we had write-offs of $2,300. $2,300. And that gives us an unadjusted balance at the end of the year of $700. Okay. So there's the accounts receivable with all those things posted, and the allowance with its beginning balance and the write-off and its unadjusted balance. Okay, now let me see if I can figure out what they're doing here by what I'm looking at. Okay, January 31st. 2024. Looks like they're computing a bad debt expense, and it's 10% of the accounts receivable balance. Okay, so the accounts receivable balance is $54,700 times 10% would be $5,470. That's this calculation down here. That's the balance of accounts receivable times 10%, $54.70. Now, again, when we're using a balance sheet approach, a percentage of the balance in accounts receivable, the computation is going to give us a target balance for the allowance account. So that balance is what we want up in that T account. Okay. So we want a balance of 5470. Okay. Target balance on January 31st, 2024. So I'm taking the targeted balance that we computed. That's what we want in the allowance account. The allowance account has a $700 credit balance in it already. So the difference between those two numbers is going to be our adjusting entry for our bad debt expense. That number is going to be 4,770. I'm just using a red pen so it'll stick out. Okay, that's how I figure the amount I need to increase the allowance account to get where I want it, to get it to be the balance I wanted. So the entry would look like this: bad debt expense, debit $4,770, allowance for bad debts $4,770. There's the entry that got me that 4,770 credit to the allowance account. Bad debt expense, we just start the year at a zero balance, and you put 4,077 in it as a debit, and that's the balance at the end of the year. Last, they want to see what the balance sheet presentation would look like. Again, we've done this twice before. Do it a third time, maybe we'll get good at it. Hilltop flagpoles. Let's see. Balance sheet. January 31, 2024. Assets. And you'd have current assets, and the first one would always be cash. And more than likely, the second one is going to be accounts receivable. That's what we're interested in right here. Let's say cash is $50,000, just to have a number in there and make it look good. And then we're going to say accounts receivable balance gross 54,700 less the allowance for bad debts. And it was 4,570. And that'd be 49,230 net amount. And that's what we're looking at. Heading, name of the company, name of the statement, the date, assets, current assets. I just made that up, $50,000 balance. Gross amount of accounts receivable less the allowance gives you the net amount of the receivables. Okay, that's it. Let me check. 16, 20. Yeah, that was 20. And there are no problems. So, okay. Hope you enjoyed it. Hope you got them. If not, try them again and check yourself against the video. And remember, partial week off. Do the assignments for Chapter 8, and if you got them, fine. Take the whole week off. If not, try to do them again and see how you did. Compare what you do with what I've done. All right, talk to you next week.